while we talk about the fact that we've had this impressive employment gains, it really wasn't until the January of this year that we got to that net zero position, where we finally saw growth that was strong enough to basically employ not just those who lost their jobs, but also those who were coming into the labor market. But you can notice the fact that we still have impressive gains here. And, so part of my story is when you're adding this many people to your workforce, for example, in that period of the 2014-2015, the fact is you had nearly a 2% gain to your labor force. Well, if the economy's only growing at 2.3% and 2% is coming from your workforce, you don't need to be buying a lot of equipment to meet that. So we had this real substitution of labor for capital. And I think there's a lot of reasons for that. We have seen unemployment rates now that have fallen to incredibly low levels after reaching a 10% peak. We have seen it fall by 5.6 percentage points, so we are at 3.6%. But again, it took us about 10 years to get back to that kind of pre-recession low of around 4.5% unemployment rate. So it's been slow. We've heard about the wage gains that are happening, and they are. The green line there is the employment cost index for wages and salaries. The red line is the benefit cost. And you can see both of them are kind of moving a bit higher, but neither of them is setting the world on fire, which is, to me, and to many of it, kind of shocking that you would think with this, if everybody can't find qualified workers, and we should be seeing a lot more wage activity with regard to that. And it gets concerned, as I think it was mentioned, that increasing wage pressure add to cost pressures for the firm, and could we be setting ourselves up at a 3.6% unemployment rate for a wage cost spiral with regard to inflation? I don't think so, and I'm going to talk about some of the reasons for that. And I think we are anticipating more wage gains, which I think is all in all a good thing. This labor for capital substitution was occurring in part because wages were not rising very much. Workers were a bargain, and workers were a much safer way of expanding your business. Many of you will recall coming out of the Great Recession, there was a view that, are we going to double dip? What's the next leg to kind of fall off that's going to lead us into another downturn? If you hire workers, you can shed those very easily. If you buy a piece of equipment, especially now, increasingly those are so automated, their replacement is a much shorter life cycle. So you really want to time those quite well. So here I'm taking the fact that workers' wages were very reasonable. The green line is the employment cost index for private industry workers, and I'm correlating that against a 9-month differential using our good friend Bill Dunkelberg's National Federation of Independent Business Survey. One of the questions he asked is, do you plan to raise workers' compensation? And with an 84% correlation, you can see how nicely that lines up. There was a break, back here a little over 10 years ago, where wages were being talked about increasing much more than they actually did. But when they kind of corrected, they corrected by having the wages actually go up to meet what they had been saying. So with a delay, they weren't lying. It was just with a delay, those wages finally moved higher. You can see the gap has opened up now, which would be suggestive of something closer to, rather than seeing 3% nominal increases, maybe something closer to 4%. So maybe a full percentage point higher. And I think that is certainly a possibility as we move into the rest of this year. But productivity has suffered. And I think this is really the explanation of why wages have not been been done. As we are all aware, in terms of workers, real gains occur based upon how they are doing with regard to their contributions for productivity. And productivity increases. This is a 5-year moving average. So the very fact that we are looking at a period where productivity, which would normally, given if you think labor force of 0.7, 0.8% contribution to growth, productivity about 1 to 1.25%, that's how you come up with that 1.8 to 2% view of the Fed has for growth. We should be looking at a number here that at least on the bottom should have a 1% handle. In fact, we were well below it. And this is, again, being a 5-year moving average, this period here represents about 9 years of sub 1% gains for productivity. And so I think that's in large part why we've not seen the increases on wages. But you can see the fact that more recently, those have started to occur. So I think one piece of the puzzle of why productivity has suffered has been this labor substitution for capital. And in fact, you can see that here when we look at non-residential fixed investment, it had just basically been trending lower. In fact, they have the little arrow there to show you the fact that it had gone down. In fact, we had a period where in 2016, the capital spend was actually negative during an expansion. Very, very unusual. Now, we all know it goes down during a recession, but not typically during an expansion. The good news, and this is even prior to the tax stimulus, which I think is more, what I've heard from our contacts is a bit of, it's added some sweetener to the concept of investing. Tax incentives as well as lower interest rates, they're helpful. But businesses are not going to buy a piece of equipment because of those two factors. Because ultimately, they will buy that piece of equipment if they could put it to use. So demand is critical. Again, they're helpful, but you need to have that demand there in order to accomplish it. And beginning in 2016, in large part, I think the story was they truly were finding it hard to find those workers. They had not invested for quite a while, so the new equipment was really quite impressive for productivity. And you can see now, if we look at the productivity on a year-over-year basis, you can see the more recent numbers have really bounced back and well above that 1 to 1.25% that we think of as more normal. I think that investment cycle that we're currently in is helping to foster this productivity gain. So again, all in all, quite helpful. And I think that's going to be our savior with regard to this increasing wage pressure that we're likely to see, is that if workers are delivering greater productivity, you could pay them more. If somebody is 1% more productive than they previously were, and you pay them 1% more in additional wages, it's a net zero. In fact, we have an economic statistic that does that. It's called unit labor costs. And unit labor cost basically takes a look at how much is it costing your labor, and what are they doing with regard to their output, and taking into account productivity. So if this was a story of a wage cost spiral about to impact the economy, we should be looking at, well, we knew that was a story back in the 70s. Look at the 70s, what that data looks like. We're not seeing that. And in fact, productivity has come roaring back so much of late relative to the benign wage gains that continue to occur. Unit labor costs are actually going up. Well, they're not. Unit labor costs are negative compared to where they were a year ago. It's costing us less to have workers now than a year ago. So again, this is certainly good news in terms of continuing to want to hire workers. And in terms of profits continue to improve. We talked about the fact that we're on the verge of having near record high levels of the stock market, and that's all part of it. And then when you look at the inflation measurement, I know Jim Bianco put up there the PCE, and he was was using core, but keep in mind, the Fed does not have a target for the core rate of inflation. Our target is with regard to the top line inflation. In fact, last week, the Fed came out with the most recent view, and it's very similar to what was being offered up by Catherine, which is basically that it's going to be kind of a softer year this year. Some of that is the energy story, where we saw those prices come off quite a bit from what they were at the end of last year. But as we move into 2020 and 2021, even with, in my view, and probably an expectation of improved wages, we're looking at productivity offsetting that, so that the expectation is that inflation remains well contained, close to the Fed target of 2%. So that's my story and just my summary point, and then just a couple of our links if you're looking for stuff for the Chicago Fed or the stuff from the Federal Reserve. If you're looking for the information with regard to the last FOMC cycle, you could find that from the Summary of Economic Projections at federalreserve.gov. So thank you.
Thank you, Bill. Like the last session, let's reserve the questions for the last part of the session. Kevin?
Thanks. And how was I going to time it? Okay, I did too.
Okay. Again, I also want to add my thanks to Don and Jill from the GIC and for the invitation extended to me and as a representative of the St. Louis Fed. So my presentation is going to be a little bit, I think, fairly complementary to Bill's, but I'm going to focus more on the outlook for business fixed investment. So, if all goes well, on July 1, the current expansion will become the longest on record. And the natural question is, will we get there? And, the hazards of forecasting suggest you want to qualify your answer appropriately, but
we're a few days away.
I know,
Have a little optimism there, Kevin.
Things can happen, I've been in this business too long. So I think we'll probably get there, but it is the case the recession risks have risen, depending on kind of what model you use. And so when we think about sort of forecasting the economy or monitoring the economy, certainly look at many variables to gauge the strength of the weakness of the economy. I think two important gauges are labor markets, and Catherine talked about that at lunch. It looks to me like labor markets are not signaling any imminent downturn. Almost all labor market series that we can look at are still pretty healthy. Now we have to admit the labor markets tend to be a lagging indicator, and the demographics of the population have changed. So kind of the labor hoarding that we tend to see in the late cycle and early recession. So those dynamics maybe have changed a little bit. We're not quite sure, but at this point anyway, if you're judging solely by the labor markets, the economy still looks pretty decent. Another indicator is business fixed investment. I'm going to focus on that one. So why does investment matter? Typically, if you sort of think about kind of a standard growth model where you're trying to model output per worker or output per capita, that's kind of a measure of living standards over time. You can think of it in terms of various components. One thing is worker knowledge, the importance of new ideas, generation of new ideas clearly are very important in this framework. You can think of the work of Paul Romer and some other people like that, the endogenous growth theory. Another key factor is investment, fixed investment per worker, netted appreciation. So the idea is if you lift investment rates, that tends to, all else equal, increase productivity and increase real income. So I'm going to approach it from that kind of standpoint. Now, just to also also add my disclaimer. These views are not necessarily mine, not necessarily those of not necessarily those of the St. Louis Fed. You know, I'm not making this stuff up, I promise. All right. So what I'm going to do is kind of a two-part kind of presentation. One is kind of focused on kind of short-term or more cyclical developments, and then the last part take a more longer-run approach. So when you think of business fixed investment, first thing you think of is very cyclical. It's very volatile. This chart just shows you the four-quarter growth of non-residential fixed investment over the past 4 quarters. And the vertical shaded areas or recessions. Bill pointed out the very steep drop in GDP in the last recession, financial crisis and Great Recession. You kind of see that here. The decline in real business fixed investment percentage-wise was the steepest in the post-World War II period. Again, it moves around a lot. You can see there at the very end, the tail end there's been a dip down. So growth in this expansion has been, fairly volatile. It's been as high as, 12, 13%, but now it's around 5%, which is not bad. So the question is it going further down from here, or is it going to recover? So that's kind of the key question. So you can look at several indicators. This solid black line is a compilation. So there's 6 Federal Reserve banks that do business surveys, and they ask their respondents what their expectation is for capital expenditures over the next 6 months. And the NFIB, the Small Business Association that Bill Dunkerberg heads up, at least the research arm, also asks the same question. So you should read this chart as anything above 0 indicates the percentage of respondents expecting to increase capital spending over the next 6 months is greater than those expecting a decline. So anything positive generally means that firms and respondents are expecting higher capital spending over the next 6 months. It doesn't quantify the magnitude, it just quantifies the direction. All right, so you can see at the tail end there, 2017, it was fairly high, at least the longest in this time series I have going back to 2004. It's come down a little bit, but again, it hasn't seen near the drops that we saw in 2015 and 2016, and especially, obviously, not in the Great Recession. The dotted line is the growth of core capital expenditure orders. So this is non-defense capital goods, excluding aircraft and parts. And again, kind of moves along the same kind of pattern. The correlation is not perfect, obviously, because what people say they're going to do and what they actually do is sometimes two very different things. But nevertheless, again, we saw the weakness in 2015, 2016, and there was recovery, and then we've seen a little bit of a slowing recently from last year and into this year. So certainly orders have come down sharply. Now, if you look at another survey, this is the Business Roundtable survey, asked the same kind of question. These are largely CEOs of very large companies, same kind of deal. They're reporting capital expenditure plans over the next 6 months, percent higher, less percent lower. Again, you saw a very sharp increase in 2017, and then some modest erosion over the past year or so. But again, nothing suggests, at least through the second quarter anyway, the businesses are expected to, or anticipating or reporting that they're going to sharply curtail capital spending anytime soon over the next 6 months. All right, now obviously these things were taken before the announcement that the president was thinking of putting in tariffs on Mexico. So obviously if we take that survey today, it might be a little different, but nevertheless, at least before that episode, there was some erosion, but nothing very, very dramatic.
Kevin, I thought the latest Business Roundtable survey was taken during that period.
I thought it was early June or late May.
Which is,
I know from talking to the author of it that some of it encompassed that.
Okay, so so the survey
Not all,
period.
some of it encompassed.
Yeah, so some may have had filled out their survey after that announcement, that's true. Yep. Okay, so what I'm going to do now is kind of unveil, I've talked about this probably before, but it's kind of a new forward-looking indicator of business investment that I've been working on. I ran this out in a program in Atlanta that Bill and I did, and then I did it before our pre-FOMC meeting internally. So didn't get a lot of pushback, and I've done a little bit of work. But basically what I'm trying to do is I'm trying to measure a leading indicator of capital investment based on sort of different theories of business investment. So there's many models of business investment. You can think of the accelerator model, which depends importantly on sort of future growth, and Tobin's Q, cash flow, and there's other things as well. The literature seems to suggest that the relative price of capital matters a lot, but interest rates generally do not matter. So the literature suggests that business investment is not very interest sensitive. Others believe that theoretical models that don't depend on theory, sort of VARs, are the best predictors of investment or the change in the capital stock K. Now, since Bernanke, and he didn't invent the literature, obviously, it goes all the way back to at least Frank Knight in the late 1920s, but the literature really abounds on the importance of uncertainty as a predictor of investment. And this literature is huge and continues to grow, and probably undoubtedly will grow even faster and more after events of this year. So anyway, so what I'm doing, and you can kind of see this here, the uncertainty measure. This is Nick Bloom's measure with Steve Davis over here at the University of Chicago. You can get this data on policyuncertainty.com. And basically, they're trying to measure economic policy uncertainty using different metrics. And you can see that the dotted lines show you the averages for the expansions. And you can see the current expansion, the average of uncertainty has been much higher than the previous two expansions. So that undoubtedly has had some erosion on firms' willingness to undertake capital expenditures, right? So this leading indicator, I'm taking 15 variables that are used in different theories of business investment. I'm using a principal components methodology to estimate a latent variable. This is the black variable there. And the red line is real business fixed investment. And you can see it does a fairly decent job of preceding that. The correlations at the bottom of the page show you that the index is pretty highly correlated with business fixed investment growth, at least over the next 2 quarters, and a decent correlation, 0.58, over the next 3 quarters. So, from this standpoint, again, it's a very simple analysis, but it does suggest that if you look at the very end data point there where the leading indicator is turned negative, that suggests that there is some scope, at least according to this index, for slower growth in capital spending, maybe over the second half of the year and into 2020. All right, and this is just a longer-term measure of forecasts from the CBO and Blue Chip on business fixed investment. It kind of shows kind of the same thing. Forecasters expect erosion in 2019 and 2020, and then maybe some stabilization thereafter around 3.5% to 4%. All right, so the last few minutes of my talk, just want to talk a little bit about kind of longer term issues. And this is the rise of intangible investment. So if you look at the composition of a business fixed investment, the composition is changing dramatically away from tangible investment to more intangible investment. There was a book out last year called Capitalism Without Capital that talked all about this. And then the academic literature, Chad Severson, who's over here at the University of Chicago, along with Eric Bjornolfsson and Daniel Rock from MIT, have what I think is a very important paper in which they argue that if you accept the notion that machine learning and artificial intelligence are new general purpose technologies that have the potential to really revolutionize productivity and living standards going forward, they argue that these general purpose technologies require significant complementary investments, and these investments, to a large extent, are often intangible in nature and hard to measure, right? So you can kind of see this. I'll skip the table that kind of shows you in the NIPAs, the National Income and Project Accounts, what tangible and intangible is, but software and R&D are key components of intangible investments. So this chart just shows you the change in trends of the composition of business fixed investment since 1960. The top line there is equipment. Again, these are nominal shares, not real shares, because the NIPAs use Fisher ideal weights. They're not additive, so I like to use nominal shares. You might get something different with real shares, but technically you should use nominal shares, not real shares. Nevertheless, you can see that both equipment and structures, the orange line, have been trending down over time, and intangible investments, what the NIPAs call intellectual property products, has been increasing sharply over time. So this has, I think, put us on the cusp of, maybe something. I don't know what that something is yet, but clearly it has, I think, the potential to really dramatically change business in many ways. Obviously, the intangibles have displaced tangible investment to some extent, when we kind of saw that in the previous chart. But also, I think, rising share of intangible investments has potentially significant implications for society and the economy. You can think of, okay, if you're relying on people to build software and databases and research and development, obviously education policy is extremely important. If you're putting in place different business managerial processes or wireless networks or some other sort of thing that uses a lot of these intellectual property products, then that is also going to be significant as well. And then finally, for economists and national income accountants, the measures of the issues of measurement and modeling are very paramount. So anyway, a lot of things to think about going forward as intangible investments become increasingly important over time. So anyway, thank you very much. And I guess I'll turn it over to Leslie.
Thank you, Kevin. We'll have now Leslie, you want to come up? And we have a shift in gear a little bit, away from investment onto the labor force.
Yes, I have the same disclaimer. So if we're sort of looking at what the determinants of economic output are, it's really two factors: output per hour, which is really worker productivity, which Bill and Kevin touched on, and then the number of hours worked in the economy. And so the number of hours worked is really this question of what's going on with the labor force. And in that way, there are sort of two pieces. There's the extensive margin, so how many workers you have available to work, and that's the labor force, which is determined by population and whether people are available to work, so labor force participation. And then there's the intensive margin, which is how much people who are part of the labor force work. So how many hours, how many work among the willing, so how many people find jobs, and how many hours those people are able or willing to work. So total hours in the economy sort of can come down to this convenient formula at the bottom, which is determined by population, labor force participation, the employment rate, or 1 minus the unemployment rate, and the number of hours per job. So if we look at kind of what is the prognosis for the coming decade, sort of what are we facing? On the extensive margin, things aren't looking particularly good. Population growth, and I'll go through each of these in turn, population growth is slowing. Whether folks are available or willing to work, so labor force participation largely for demographic reasons is slowing. On the intensive margin, things are a little bit better. So how many work among the willing, that seems to be improving a bit, or the forecast is for that to improve a bit, for the natural rate of unemployment to fall. And that's largely for the same demographic reasons that folks are increasing their participation, and how many hours they want to work, that's already high. There's some ability to tweak this margin a little bit, but relative to other countries, it's high. So what's the story with population growth? So the figure on the left shows 1 year percent changes in population growth, so the annual population growth. You see these big jumps up in census years, which is just kind of sort of recalibrating. But if you look at the very end of the graph, you see that the numbers for, so the prognosis is not particularly good for the coming decade. Population growth is supposed to be slower than it's been historically. And on the right, this sort of shows the 3 ways your population can grow or shrink. One is that people get born, the other is people die, and the third is that people can move in. So if we look at the forecast for what's happening with the birth rate in the U.S. is forecast to decrease, and that is really just a function of both the demographics of the aging of the population and choices amongst number of children. And so the Census Bureau is forecasting the birth rate to increase. It's also forecasting the death rate to go up. This again is largely a function of pure demographics and what's happening with the ages of the baby boomers. So if you look at the gap between the birth and the death rate, that sort of natural increase of the population, and that's narrowing and forecast to narrow throughout the remainder of the decade. And then the immigration forecast, as we discussed, is like really hard to guess at, but the forecast is for something relatively flat. So if you put those all together, you get the forecast, you get the figure on the left. So population growth doesn't seem to be something that's going to be increasing at a rate that's particularly robust. The second piece of that, of my equation, is labor force participation. So whether people are willing to work. Labor force participation in a lot of ways is the most interesting of those 4 pieces. So the definition that I look at is the percent of the population that's available to work that's above the age of 16, so above the legal age of work. And it can, of course, differ across groups at a point in time. So different groups in the population, especially by age, have different propensities to work. It also can differ within groups over time. And the examples of this, the most prominent examples are the return of the real entry of women into the labor force and changes in prime aged men, which I'll leave to Jeff to talk a little bit more about, and some really interesting changes in what has gone on with teenagers. And of course, these can differ across phases of the business cycle. I think one of the things I'll talk about a little bit is what we've learned from the current cycle about how flexible participation is. So we put the demographics, the structural factors, and the cycle together to get a number. So what's been happening with labor force participation? This is sort of a well-known graph, but the graph on the left is the much longer time series. The graph on the right is really just since the recession. So we saw this, sort of massive run-up as women entered the labor force. We saw this drawdown as the baby boomers have aged. And we've seen this sort of like flatlining of labor force participation over the last number of years, largely for cyclical factors, kind of defying some of these demographics. So the biggest force bringing labor force participation down is really the aging of the population. If we look on the left that shows the labor force participation rate of different age groups in the population. So the labor force, and this includes all people above 55, so it's not cutting you off when you turn 65. So, the labor force participation of those 55 and over is relatively low. The next lowest group is teenagers. Teenagers, some work, some don't. There's been a real interesting structural decline in this over a number of years because teens have been spending more time in school and doing stuff to get prepped for college. And then finally, the groups at the top are mostly prime-age men and women. But if you look at the graph on the left, you can compare to the graph on the right, the colors are the same, that the group with the lowest labor force participation is the group that is not only increasing in the population, but is forecast to increase as a share of the population going forward. So if we put these all together, you can see what the labor force participation has been over the last number of years, as well as two forecasts that are put together by some of my colleagues at the Chicago Fed in terms of what the forecast is for the labor force participation rate going forward. And it's fairly grim. So the notion is that the long run trend is down just because largely of the demographics of the population, but the underlying model actually has follows the trend of various different cohorts as well. So you can see, the couple things here is women entering the labor force, boomers aging, and then the cycle part of that we've kind of defied this demographic downshift, and maybe labor force participation according to this is above where you would expect it to be because by trend. So this is sort of flat, this flat number that we've seen for the last few years is really sort of defying this downward trend because of the strength of the economy. So the other sort of piece of the labor force participation rate that's kind of interesting is what's been going on, especially for prime-aged men. So if we look, the numbers on the left, the graph on the left shows the long time series of labor force participation by different demographic groups, men and women by age. But more interesting, if you look at the graph on the right, you can see how much labor force participation has declined over the last number of years for prime-aged men. It used to be almost a given that a male between 25 and 54 was in the labor force. These numbers were like 96, 98%, and they've fallen fairly precipitously over the ensuing decades. So if we look at who's not in the labor force, sort of who's available to bring into the labor force, and this I just cut off at age 64. If we look at the first time that we were able to do this breakdown in the data, which is June of 1976, 21% of those who were out of the labor force were prime-aged men. So that's the 21% with the little arrow. If we look at the most recent data, so May of 2019, 39% of the people out of the labor force are prime-aged men. Okay, so that was sort of the first two pieces, population, labor force participation, giving you what's going on with the labor force. Now what part of the labor force is employed? So as I mentioned, this is sort of the 1 minus the unemployment rate. So what's the forecast for the unemployment rate going forward? And that is for the natural rate of employment to fall somewhat. So the employment rate out of the labor force is expected to increase modestly. And a lot of this is the same factors that is expected to bring down labor force participation. In particular, as the population is switching from teens to older people, we tend to have higher employment shares among older people than among teens. And then finally, what the last piece of that formula was is hours. So what do we think of hours? Hours in the US are already fairly high. The numbers on the left are averages from our two major surveys. The household survey is the higher numbers when you ask people how many hours they worked. And the red are when you ask employers how many hours people worked. The difference between the two is largely because people can hold more than one job. It's not because people are incorrectly forecasting the number. Like, I worked 100 hours last week, and the Fed's like, no, you didn't. So the gap between the two, but the notion is that these numbers are already pretty high. The chart on the right is just average hours of work in OECD countries. What you can see, the US is green. So of the G7, the hours worked per year is highest in the US of G7 countries. This may be something that can increase, but there is this notion that relative to other wealthy countries, we actually work quite a few hours. So where does this leave us, putting sort of the four numbers together? Population growth seems like it's headed in the wrong direction. For participation, demographics are a very strong headwind, and this is sort of the underlying story of why the forecast for economic growth of the U.S. is so modest. If you're going to add productivity and labor force activity, it seems like it's hard to beat the demographics. But there are certain interesting things that can happen within groups, and I think this is what Jeff is going to talk about, sort of the prognosis. Maybe if we could get those numbers for prime-aged men up, you would have some upside. The next thing about participation is what we've learned from this cycle. And I think we've learned from this cycle how flexible participation can be, that the demographics are not necessarily destiny. As I've shared with Bill, I actually right now have 2 employed teenagers. This is like a both. Now I can go home. No, this is something of a miracle, right? But it's largely a function of what's available in the labor market, right? My daughter turned 16. There's a new ice cream store. They say you're hired. She doesn't have any idea what she's doing, but it's sort of participation as a response to economic conditions. The natural rate of unemployment that's heading in the right direction, but modestly. And hours, again, are already high. They could increase. There is some upside. There's a real question. I'm kind of a tax junkie about what happened with the Tax Cuts and Jobs Act with hours. That was one of the areas in which the incentives were sort of for increased output in the economy, especially the expectation was among second earners. And so there's some question there that some of the incentives are in the right direction, but we're high already. With that, I will turn it over to you.
Thank you very much.
Thank you, Leslie. Great segue for Jeff.
Thank you. And now for what might at first glance seem like something completely different, but it really isn't. And entitled this as Redemption, Inc., How We Bring in Marginalized Workers Back in the Workforce. I think there's a subtitle here. This is business, not charity. And we're going to talk a lot about the social ills that have sidelined workers. But at the heart of this, this is a business talent acquisition strategy that does work and can work, and it's based on the small and medium-sized businesses we've studied that do this. Just to ground us graphically in what has already been discussed, the components of long-term growth in any economy. This is the CBO's data on U.S. growth and potential growth, green being labor force growth, blue being productivity growth. How fast can you grow your workforce, and how productive can they be? And that's the essence of growth. And if you look at this, the bars on the far right, of course, are a projection 2018 to 2028. You can see that we are, as everyone knows, a workforce-challenged country. We just can't grow our workforce fast enough to promote very strong growth. And of course, there are a lot of challenges to growing at sub 2%. There are political challenges. There's the fact of the natural variability of growth. If you're growing at sub 2% growth, it's that much easier to slip into a recession. And all of those challenges do not bode particularly well for long-term U.S. growth. It's a particularly relevant factor today when I think there's a very good argument to be made that we're at full employment. This is the long-term unemployment rate of the U.S. economy, of course. And while it is possible that we can get the unemployment rate down below 3.6%, there's not much historical evidence that we can do that for any sustainable period. And in fact, it looks, at least at first glance, that we're in one of those periods that precedes a recession when you run out of room to grow. That's the very real risk that I think we face today. And then we go back, of course, to the labor force participation rate. You just saw it in the previous presentation, but this is, of course, the other factor, and one that we all too often take as a given. And while I agree with Leslie, the long-term trends are certainly negative based on demographics, but we should not dismiss the possibility of policies and actions that can improve this, at least over the short to medium term. The aging of the baby boomers probably accounts for about half of this decline in labor force participation rates, and the rest is those missing workers, as particularly exemplified by the lower labor force participation rates for prime-age men, and particularly acute in the drop of young men, 25 to 34-year-olds. And what we argue is that this is largely due to three social ills, and the automatic response when you start talking about social ills is, yeah, social justice warrior, whatever. But the reality is that, as I hope you'll see from the data that we're going to present, this cycle really does have something different going on, and that the degree to which these social ills have impaired the labor market is not just a difference of degree, but really a difference of kind. And it starts out with that slow recovery that Bill talked about, and the slow pace of the recovery and what that did to the average duration of unemployment. Chart on the left here is the average duration of unemployment. Chart on the right is the percentage of the unemployed who've been unemployed for 27 weeks or longer. And I think you'll see right at first glance that something different was at work this cycle. We simply sidelined workers for too long. A combination of the weak growth rates, the weak rebound from the Great Recession, and probably also some well-intentioned policies that had adverse consequences, the extension of unemployment benefits. Whatever the reason, we had a lot of long-term unemployed. And we know from all sorts of corresponding studies, most notably some very good longitudinal work done by the Brookings Institution, that once you hit that 27-week mark, your likelihood of dropping out of the labor force increases dramatically. And some of these studies even looked at people who, once they were long-term unemployed, came back to the labor force, it tended not to stick. So long-term unemployment, whether your skills become obsolete, whether it just becomes psychologically difficult to go back to the workforce, whatever the reason, once people are long-term unemployed, they tend to drop out of the labor force and stay out of the labor force. I would note that even now, taking a look at the chart on the left, here we are, about to come up upon the longest expansion in at least modern U.S. history, and we still have an average duration of unemployment that is above the peaks of previous cycles. I mean, that's striking. Likely related to that is the impact of the opioid epidemic. This is just a visual representation of that survey work that was done by Alan Kruger, where they surveyed people who were not in the labor force and looked at attributes, and one of the most common attributes was people were taking pain pills. The other way to look at this is to take a look at HHS, Health and Human Service estimates of people who are taking opioids for non-medicinal purposes. They estimate 11.5 million people in the United States are taking opioids for non-medicinal purposes. Of those, more than 2.1 million would be what we think of as addicts. This is obviously a great tragedy, particularly those who are full-blown addicts are likely on their way to be part of that terrible statistic you hear about all the time. Drug overdoses killed over 72,000 Americans in 2017. Opioids are the large reason, and that is accelerating that growth rate. Obviously, when you look at numbers like 11.5 million people abusing opioids, many of those are in the labor force. But it is, I think, somewhat obvious if you're an abuser of opioids, you are not performing up to your full productivity potential in the labor force. And very specifically, you no longer qualify for jobs in manufacturing, construction, transportation, healthcare, jobs that will continue to require drug testing for workplace safety reasons. This is a big issue in certain geographies. Some of you know Fifth Third is headquartered in Cincinnati. We bank local hospitals where they have more overdose deaths than births every year. This is an incredible tragedy. But when you have 11.5 million workers or potential workers who are impaired, this is also an economic issue. The third social ill that we believe is different this cycle and a difference of kind is the growth of incarceration in the United States. And this really got going in the 1980s and then just accelerated in the 1990s. We incarcerate, these are rates of incarceration per capita. We incarcerate people in the United States really like nowhere else. And I always tell audiences as someone who has been a victim of property crime and a victim of violent crime, I'm not passing judgment on whether this is right or wrong. Bad actions should be met with consequences. Some of those consequences should involve incarceration. Where we truly fail is in our ability to take people who have been through incarceration or have a criminal record and get them back in the workforce. There's a real lack of good statistics. There is one kind of particularly good data set from the Bureau of Justice Statistics, part of the Department of Justice, where they have tracked people who've come out of state prisons. That's the vast majority of people who are in prison are state prisons. And by 5 years out, 76.6% of people who've left state prisons are rearrested. I mean, what a colossal waste and colossal cost. It's also been a particularly acute cost in certain communities. The two maps on the top line are 1980 situation. These are rates of incarceration per capita. You can see on the right-hand column, the African-American community has historically had greater rates of incarceration, but look at what's happened by 2010. You have a overall increase in incarceration, but a devastatingly high rate in the African-American community. We flip this, though, and we say, what if we could turn this around? This is actually a labor force opportunity. There's a lot of bad numbers out there of how many people really have been impacted by the criminal justice system. The number we like to use is that one highlighted in green. There are 19 million people in the United States with a felony conviction. You subtract out those incarcerated, you come to the conclusion that more than 16 million people in the United States outside of prison have a felony conviction. And while many of those are employed, I would venture to say all of those who are 12 or 13 million who are working age are underemployed. And this should be viewed as an opportunity. At times they are changing. We have the business community for the first time starting to look at this. We have the First Step Act, the most significant criminal justice reform in decades that passed in December, which is very focused on the federal prison population controlled by federal legislation, wildly bipartisan, passed the Senate 89-11. And we have initiatives like SHRM, the Society of Human Resource Management. Their single biggest focus this year is getting people with criminal records into the workforce. The U.S. Chamber of Commerce is also taking this up. Biggest sign of change, and this, Don Rissmiller asked me to include this last night. This was from the White House 2 weeks ago, the Second Chance Summit. The fact that I'm in a picture with Kim Kardashian, Ivanka Trump, and okay, it's just part of my head, but if I'm in with the beautiful big people, surely times they are changing. And I was delighted to find out this was on Ivanka Trump's Instagram. We found that there is a true model for success. We've looked at businesses that have done this hiring for decades, and they all come up with the same model of success, a partnership using nonprofits to identify who's ready for employment out of this population, business owners who have to understand some accommodations, time to meet with parole officers, ability to refer to other services that typically afflict people with poverty, housing insecurity, food insecurity, and obviously government action can help in this regard. There are benefits to the employers that do this. There's not a lot of studies of this. business, but all of them point in the same direction. People with criminal records, once you follow the model, you find the ones ready and you give them the tools to succeed, they are more productive workers and they are very low turnover workers. That turnover results in really great pickups for businesses. This is a business in Cincinnati. 130 of their 160 employees are second chance hires, to use the terminology, and they find that a better than 5% gain in cash flow for their business because of this low turnover. Low turnover tends to mean higher productivity, highly engaged employees. There are other models out there, transitional employment. We can do a better job with work release programs. There's advanced professional training. All of these have terrific track records of success. Even entrepreneurship might have a future among this population. We think it just needs time. The business community is starting to get this. The payoff in terms of number of workers, that male 25 to 34 population, every point we move labor force participation is nearly 250,000 workers. They're probably 5 points behind where they should be. If we add to that prime age population improvements as part of that, each point we can move is 1.25 million workers. And then if we undertake broader initiatives and can move the whole lever of total population, every point we can move up in labor force participation is 2.5 million workers. A big task, but also a big opportunity. With that, I'll conclude and we'll go on to the questions. Thank you.
So we have about 10 minutes just to give a quick summary. So Bill talked about the absorption of the reserve army of labor, Marxian view of things. Thank you, Bill. But the importance of increasing the productivity growth, which leads me to Kevin, who touched on the intangible investment, which of course might include or must include AI in the future. And that's, I think, a little bit of a glimpse into maybe what can happen to the labor market. Leslie did speak about the fact that we top the hours work. Maybe AI might help that. And we ended with Jeff talking about a very specific point of the labor market in the near term and the necessity of some policies that could help the participation. So with that, questions? Yes, please go ahead.
I, like probably everybody else, just kind of befuddled by the fact that wages haven't gone up. You know, everyone's worried about that or thinking about it. Why is it different this time? Is it in fact the dominance of technology? It seems like so much technology has come in and taken over certain jobs. I don't know. I just don't know. I don't know enough about it, but my hunch is that technology is disinflationary and that type of thing. What do you think?
I mean, we've had technology advancements going back generations, and yet we've seen improved living standards. I think, again, I think what was going on was the fact that we had this underinvestment coming out of the Great Recession. I could have put up there capacity utilization charts. We saw capacity utilizations plunge during the Great Recession. Manufacturing output fell not by 4% like the general economy, but by over 20%. And it's taken. I mean, we're still not back to our industrial output level in the post environment. So it's been a real challenge sector. And again, capacity utilization, for example, in the automotive sector, we saw that fall to levels that we hadn't seen since the Great Depression. I think that we had this too slow of an economy growth that occurred largely because of it being a financial recession and a financial crisis recession. We know, the fact is that recoveries from that tend to be far more muted, and we experienced that. The good news is those tend to last about 10 years, and we're 10 years out of that. So that's why my optimism is there that, as long as we don't muck things up, we're likely to see this this improved investment cycle go on, which will lead to the productivity growth that we're witnessing, and that will foster the gains of income. And it's that direct link between productivity growth and income growth. And it's been that lack of investment, I think, that has largely driven this sluggish productivity.
Just a quick follow-up. Was that lack of investment in the kind of NFIB type small business place or large corporation? You see the NFIB numbers were historically low for years and years, and then they shot up post-election.
Yeah, and to be fair, I mean, we did see this improvement, although it was even a little bit ahead of the election. I mean, my personal view is we were going to see a fairly decent investment cycle regardless of who was going to be president. But I think with the current administration having a bit more favorable view and relaxed view with regard to the regulatory environment, you add on to that the tax reform, which again, in my view, added a sweetener that somebody was on the cusp of whether to invest or not. They kind of did a little bit more investment, but I don't think it was a game changer. I think the investment cycle was already in train to occur. So again, I'm looking forward to seeing wages move up. And I think the NFIB index sense that it could go up as much as 1% over the coming year. So keep our fingers crossed.
We have Pat, and then we have Don.
So may I ask a question? Is it possible that we're looking at a money illusion here with wages, that if prices were going up 8 and people are getting paid 12, we'd say that's fantastic. If prices are going up 2 and wages are going up 50% more than that, people are better off across the board. You're seeing it in confidence numbers. There's tremendous resistance to price increases by consumers really across the board. So why shouldn't we just relax about this and say, gee, wages are growing up, 50% more than inflation. Things are pretty good, and confidence is reflecting that as the unemployment rate.
So I think a few reasons why I don't want to be so sanguine about it. I mean, I think again when you kind of look at the fact that for a large group of our population who have not enjoyed the benefits of the investments or equity returns from the stock market, who rely upon their incomes as their primary ways of funding themselves, they have suffered. And I think that's reflected in terms of the people's satisfaction with regard to how the economy is going. I think
are their wages now going up the fastest in the entire group, lower high school educated or less? I thought their wages are going up.
So some of that is occurring, and some of that is due to policies that I might not actually be as much in favor of being pushed up by this push for higher minimum wages. And I think a lot of these wage gains might be occurring otherwise. My concern about putting minimum wage is basically locking in these wages, which are not going to be able to adjust lower when we have a downturn, and those people are going to wind up, losing their jobs. So that's my one concern with regard to minimum wages. But you're right, even that group is, and you look at the African Americans, you look at Hispanic, we're looking at record lows on those. And the longer we keep those down, the more they're going to be able to get the job, improve their job skills to be able to remain attached to the labor market to weather an economic downturn, which we will eventually have. I don't believe the business cycle is over. We're just trying to delay it as long as we can.
But isn't that the case that what you alluded to, that in the Great Recession, wages did not come down that much, decline that much. In fact, it was the unemployment that increased dramatically. So the flip side of that is in the recovery, you did not see a major increase in wages, or it took a long time before we see that, right?
Yeah, I mean, the wages did not do well. I mean, I think what we were hearing was that people were hesitant to go in and ask their bosses for increases, knowing that there were two people wanting their job.
Exactly.
And I think that's in part the penalty that even those individuals who didn't lose their jobs during the downturn had to deal with, was the fact that their wages were not rising.
Don, you had a question?
Yeah, I'd like to ask if there's any evidence that we know of that intangible investment
can be different depending on what type of intangible investment we're doing, or maybe not all intangible investment is created equal. So going from a chalkboard to a spreadsheet was really useful, that software, but that was 40 years ago. Social media might not have the same bang for the buck as some of the other intangibles. Or is there any evidence intangible investment itself within that there's any difference?
Certainly they have different characteristics. I mean, intangibles generally have high fixed costs. They're typically discarded, unlike tangibles, which are depreciated over time. They're much more scalable. You take one idea and you can use it in a way that maybe generates a rapid level of growth. This is kind of related to this endogenous growth theory. So one of the points that Haskell and Westlake make in their book is that economies that have very high levels of intangible investment tend to behave differently and tend to be more productive, or at least maybe eventually. So that's kind of where the literature is starting to come out on that. And this, again, I mentioned Chad Severson. He's done a lot of great work in this area. And if you want sort of a deeper dive than I can give you, this is kind of the place to go. Can I just make a comment on what Bill was talking about?
Absolutely.
So, and I don't want to dispute anything Bill said. I absolutely agree with him that, if you think of wage growth as sort of the sum of kind of the workers' marginal product and expected inflation, productivity growth 1.2 to 1.5, expected inflation 2%, that gets you about 3.2, something 3.5, and that's kind of what Atlanta Fed gives you, the wage tracker. Now, I'm not a labor economist, I'll defer to Leslie on this, but some of the labor people have started to point to this fact that demographic changes are affecting the wage growth rates, that as older, more productive workers retire, they're being replaced by younger, less productive workers, and that's sort of generating kind of a downward bias on wage growth. But again, I'm not a labor economist.
And the Atlanta Fed's median wage tracker should exclude those demographics.
Yes, it tracks the same person over time.
And I just want to pop in one thing on your question, is that the other thing with intangibles is they're just so hard to measure, as you mentioned. Both, some of it is what they're worth, but also like the value that people get out of them. And I think that that's one of the challenge actually for our economic statistics more broadly, is that we're spending a lot of our leisure time doing things that we weren't doing before, and we might be better off, but they're not in the measures, which is another kind of.
But we also see that if we have older workers retiring, being replaced by younger workers, and that's one of the explanations for why productivity is down, all that tech training is doing nothing.
Well, again, if you believe in learning by doing and you accumulate knowledge over time.
I'd say the learning by doing is much more important than the technology. The ability to use the iPad is not, right? Yeah.
But, did I hear well that you said the intangible carry a lot of fixed costs?
Yes.
Okay.
There's a lot of sunk costs to those.
Right, so that's the training of people for the new software, for example.
Training, developing new business processes.
Correct, okay.
New databases,
And that's not part of the measurement of investment, but it's essentially, as you point out, a fixed cost.
That's
a measurement issue, as Leslie said.
Yeah, as Leslie correctly pointed out, it's what you're doing is you're taking a lot of measured inputs using real resources to produce outputs that may not be initially measured very good.
Yeah. I mean, a good example on that, I'm sorry, and John, you will be asking your question, but a good example of that, for example, in healthcare, you have the deployment for many hospitals, the deployment of these, one is Epic, for a kind of a record, electronic record situation. The biggest cost is really to train people, and the people who train are then being hired away to other companies to train. So it's an interesting dynamic that just from one investment, it carries a positive multiplier effect, in fact. John, sorry.
This really could be for Bill, Kevin, or Leslie, but I saw in almost all the labor participation rate graphs, it looks like the decline has slowed down, so instead of being one step forward and two steps back, it's the reverse. You combine that with the fact that you have seen pickups in wage growth across the board. Do you think now you will finally start to see some leakage of the wage growth into the general inflation numbers?
So I'll take the first crack at that. So the drop-off in the participation rate was in part also reflected by the Great Recession and the 8.7 million people that lost their jobs and things like that, and we lost some people there. And to some degree, the flatness that we've seen is basically kind of getting us back to that trend line. And I think Leslie's chart kind of showed that. The Chicago Fed view right now is we're about there, and I think that kind of matches up with that data point I gave you about that we're finally at that, point of where we're kind of break even as of January of this year. I think the issue going forward is, what's going to happen with participation rates, and the aging of the population would certainly be suggestive that it should start to continue to move lower. And that is, to some degree, what we're expecting. But we were having a little bit of a discussion at our lunch table about, the fact that many people are ill-prepared for retirement. It might give a little bit of a boost to where some of these older workers, which would normally be dropping out, might not be able to drop out more quickly. So,
if I could jump in, there's some bright spots in there that are helping that flattening of it. So the over 65 have a greater propensity to stay in the labor force than previous generations. Female labor force participation rates is climbing a little bit. So that's helping, but the big demographic forces are really against this unless we can address some of these.
But what Jeff is claiming as a bright spot ignores perhaps why they're doing it, whether it's desired or not.
So it's interesting. I met with our corporate headquarters of McDonald's are across town here, and they have a very specific strategy. And I think they're ahead of most of corporate America. Some is how do you attract retirees back in? How do you attract women who've left the labor force to raise children back in? And some is kind of this inner city strategy. They're working in 30 cities. Their franchise in their headquarters building has 2 young men who've been convicted of gun crimes who are serving employees. So it's going to be in all of the above to try to arrest that wave.
So we are 5 minutes past 3. We were supposed to end at 3. Either we forego the break, or we can ask the question while we break. That is entirely dependent on the reaction of our panelists.
Or actually, how many want to take their break? No break?
Okay.
All right.
Okay, so Mike first, Jim and Natalie. Oh, I'm so sorry. After you'll be, okay, go ahead. Shoot. Make it very quick, Mike.
Since the beginning of the year, actually since December, hours worked have been declining, where 18 months ago they were rising. Self-employment fell substantially, so substantially that in the first quarter productivity report, only 0.4 hours were added. And capital spending now appears to be turning down based on Kevin's model, maybe at the end of the cycle. That does not sound like a view that is wildly optimistic about hiring. It sounds well like they're scared they might be wrong, so they're adding bodies, but they're underworking and underpaying.
Comment?
I think that was just a comment. I'm not sure that's a...
Exactly. I mean, there are other interpretations of that data.
Yeah. No.
Why would they be underpaid, Mike, if they're in a market and they want an employee that suits what they need?
I don't know. I think they're just scared.
Jim?
Yeah, for Jeff, you talked about the opioid crisis and some of the incarceration rates. Is the causality there that the economy turned down and those went up, or is the causality that they went up independent of the economy?
I think there's a lot of self-medicating going on, and so it's probably it's probably there's a reason why it's centered in the Rust Belt, or at least it started in the Rust Belt, is because those economies fell off first, and I think it's in part a reflection of self-medicating for despair. But there's both, right? It's got a vicious circle.
Just a quick follow-up. Is most of the drug abuse coming from illegal drugs, or is it coming from prescription abuse?
About a quarter of all addicts started with a doctor prescription, but then it spread. So we were absolutely overprescribing. I mean, this really persisted way past the point it should have. And then once those prescriptions, 100 OxyContin pills for broken wrist with an automatic refill, once those got into the system and then got resold, and then you kind of got this spiral of addiction. It's very difficult. I just met with a restaurant in Louisville or Lexington, Kentucky. 23 of their 24 employees are recovering addicts. So it's a for-profit restaurant. It's possible even to bring that group in, but it's a tough road to go down.
Natalie?
So isn't at least some of the sluggishness since the recession due to the loss of higher paid manufacturing jobs being replaced by lower paid hospitality, healthcare workers, non-store retail workers, et cetera, that are just generally lower paid? And so we've substituted as jobs have gone, no. Okay.
No, I think if you break it out, I think in fact most of the jobs that have been added have actually been what we would consider medium to high paid jobs. We are adding to low paid jobs as well, but I think I don't think we've seen this kind of shift. Leslie, do you?
Well, there are two ways to look at the wages, right? There's sort of like the average wage in the economy, and there's sort of these like Atlanta Fed type calculations of what's been happening for people who are on the same wage. And those wage increases have not been particularly impressive either. So, there's always changing composition, I think, and to me, like the demographic change in composition is particularly relevant, that it is this sort of silver tsunami, right? These very skilled older people being replaced by the teenagers coming in. But it's also, if you look at the data, kind of taking that composition away, the wage growth hasn't been particularly encouraging.
And I would say you're spot on with manufacturing jobs lend themselves more, at least historically, to productivity improvement and then wage growth. But we had that big dislocation. But it was over by 2011. Since 2010, we've added net 1.3 million manufacturing jobs in the U.S. And while it's petering off this year, last year was the best year for adding manufacturing jobs since 1997. So this thought that automation is replacing manufacturing jobs really isn't consistent with the numbers. We lost jobs because of trade.
And the average wages in manufacturing, we like to think that they're like the $70 auto worker. The average wages is in the $22 to $23 an hour wage.
The highest paying jobs are in services.
The gentleman there, and then Philippa.
Coming from the perspective of an environmental economist, I'd like to come back to that graph of the natural rate, peaking around 1972, I think, and sinking ever since. EPA just cranked up the first of its major environmental regulations a couple of years before the peak, and they've been increasing ever since. Blanchard has a model of the natural rate that indicates pretty clearly that things like regulation should push up the natural rate. But we've seen this period of increasing environmental and health and safety regulations during a period of substantial decrease in the natural rate. Now, the benefits that have come from both the health and safety regulations and the environmental regulations don't get measured by GDP. So it's possible that when we look at flatness in market measured wages, we're missing some non-market improvement in welfare that doesn't get put through GDP.
Yeah, I mean, GDP is not a perfect measurement of life. I mean, our European colleagues who come over here, and we saw the fact that we work more hours than most countries around the world, especially the advanced economies. They'll tell us that we work too hard and we eat too much. Those are two comments I often hear from our European colleagues. I think there is something to say about that. Keep in mind, though, with regard to these environmental, there is a cost to that, right? You don't get clean air for free. So the spending we do.
Had an article in JPE in the 1990 where they looked at measured costs of environmental regulations, air and water. 13 of 34 SIC sectors were directly affected by the regulations. All 34 sectors had decreases in output and increases in cost.
Yeah, I mean, but the increases in cost get reflected in GDP is what I'm saying. So to say that the clean air is not part of GDP, it is in fact of having to put all of these kind of clean type technologies in place to do that. If I could just say the fact that the natural rate of unemployment coming down, I mean, when I first started at the Fed nearly 40 years ago, the view was that the natural rate of unemployment was around 6%. Now it's the FOMC group is kind of thinking it's around 4.1 to 4.5 or so. I think a large part of that is technology driven. The job search costs have been driven down so much by technology. The fact that, any one of us can go and, apply to jobs in Butte, Montana tonight if we decided that's a place we wanted to live and be able to have applications in their hands by tomorrow morning. That's very different than it was, back in the early 80s.
Philippa?
There's also the improvement in
Perhaps we
health
should
and productivity.
take this conversation offline, and just for the sake of last question, Philippa, and then we'll take a couple of minutes break.
We've sort of gone beyond where it was, and maybe a different question. I was just going to say that the prescription practices contributed a lot to the opioids.
Yeah, even a couple of years ago when we would go around talking about this to audiences, I'd have people coming up to me, the teenage child was in a soccer, injury and would get 60 OxyContin pills, 100 OxyContin pills. I mean, it's ridiculous. And incidentally, their children would come home from the orthopedist or the hospital and would get phone calls from classmates asking to buy the pills off of them. It was pretty consistent.
But the regional patterns are really interesting.
Yeah, they are.
I mean, the regional patterns are kind of...
Yeah, we've been largely insulated in Illinois. As bad as you think it might be here, it's far, far worse elsewhere.
Yeah.
Well, let's have a round of applause to